Hey there, everyone. Happy Thursday, September 4th, 2025, and welcome to Chart This with Dave Keller. Such a pleasure to be back talking markets, recapping the charts, sharing insights and trends and inflection points and all those things that make the market such an entertaining way to spend our time, hopefully profitable as well. And our goal is to help inform you, help you understand what's happening, to help educate, to give you the tools and techniques you need to make better decisions, and to help you understand what's going on a little better. I've often found that investors don't get into trouble because, they're not making the right decisions with the information that they have. I find it's because of the information that they're gathering is just not the right stuff. And I found that they're focusing on the wrong things and they're paying attention to things way too closely that they shouldn't, and ignoring the benefits of a consistent and diligent process of analyzing the markets. And hopefully this show slowly but surely invigorates you to execute on your own successful routines in your process. With that in mind, we're going to talk about the charts today. The S&P rallying into the close yet again. Yesterday, we talked about the significant rally in the last half hour. Happened again today with the S&P closing back above 6,500. That's a significant milestone that really hasn't been eclipse. We're in new all-time high territory yet again. Leadership themes continue to change, though, because as you'll see in a moment, it wasn't the NASDAQ that was at the top of the leaderboard today. It was the small cap S&P 600 that performed better than the S&P and better than the NASDAQ. Offense over defense, though, still very much favoring offense. You're going to note consumer discretionary at the top of the list, consumer staples and other defensive sectors at the bottom of the list. This is very much a risk-on environment, despite all the seasonal weakness, all the headwinds, all the reasons why the market should not go up. I was taught by a former therapist, don't keep talking about what you should do. That's called shoulding all over yourself. So let's not should all over ourselves and talk about what the market should do. Let's gather the evidence and focus on what the markets are actually doing here today. Let's get to it here with the market recap. We can see that the S&P 500 indeed closing above 6,500 today. That's up 0.8% from yesterday's close. The NASDAQ composite up 1%. The Dow up about the same as the S&P. So this is kind of a pretty much everything working kind of day. And after an initial sell-off around 10 a.m. Eastern, the rest of the day significantly positive. Now, the real story, though, in terms of leadership was not growth. It was actually some of the areas of the market that have not been performing as well on a relative basis. Mid caps and small caps both up about 1.5% today. The VIX moving down over a full point, finished today right around 15.3. That is a low volatility environment by any definition I've ever used. So with the S&P making new highs, with the VIX below 16, everything else I'm about to tell you, conditions still look pretty good. Now, having said that, I still continue to see a lot of classic topping signs, things like divergences, things that happen while the trend is still going higher. You often have some of these early warning systems. I'm continuing to see a number of them. I'll grab a couple charts to share with you here in a moment. But let's first talk about some of the other asset classes. Bonds moved higher today. You can see the TLT up 0.8%. You can see interest rates generally moving lower. This is pretty normal when we're sort of standing on the precipice of a Fed rate cut. Rates tend to come down here. Now, this is the longer end of the curve. We're looking at the 10-year and 30-year points, but the whole yield curve kind of drifting down here. The 10-year point finished today just below 4.2%. The long bond yield just below 4.9%. The 5-year yield's down around 365. So we've definitely seen rates come down here. What's most interesting, by the way, and I forgot to grab this chart. What the heck? I'm going to do it. It's my show. I'm going to take a moment and look at one of my favorite charts, looking at thinking about Fed rate cuts. To if you'd indulge me for a moment, is one that Tom McClellan turned me on to a long time ago. Where am I looking? Oh, nope. I'm looking here. Chart lists. Let's go to historical charts. Tom McClellan talked to me. I saw a presentation of his years ago, and I was absolutely fascinated by using the 2-year yield as a leading indicator. And basically, Maybe this. Yeah, here we go. So in the top panel, forget about the S&P for a bottom, but in the top panel, we have two series. The black series is the 2-year Treasury yield. Okay, it's the yield on the 2-year Treasury note. The red line is the Fed funds target rate. That's the rate that the Fed is actually adjusting, right? So when they say we're lowering 25 basis points, that's the red line coming down. So here's where the 10-year yield, or excuse me, the target rate was 5%. We can see the Fed lowering rates second half of last year, then end of last year, kind of stabilizing here. And that's kind of where we're at right now. Now, the black line shows you, and Tom's point, which has actually continued to hold true for years since he originally made this to me, was that the 2-year yield, the market kind of tells you when the Fed's going to start raising or lowering rates, right? You can see in 2018, the Fed keeps raising rates. You can see at the end of 2018, the 2-year Treasury yield starts coming down well before the Fed's finally starts to lower rates, right? The bond market is sort of seeing that that's what's probably going to happen here. Rates remained, basically essentially at zero coming out of COVID. Mid 2021, we start to see 2-year yields rise. And then soon after, we see the Fed target rate rise, which is why when we saw all of this rotation here in 2024, particularly in the third quarter, certainly suggested to us, all right, we're probably going to start to see the Fed cut rates. And if you look, 2-year yield is actually very close to making a new low for 2025, slightly above that 3.5% level, but getting close there. And that's lining up with the fact that, the Fed most likely lowering rates. So his comment was, forget about trying to guess what the Fed is going to do. The 2-year yield usually moves ahead of changes in Fed policy. And that's been the case here for quite some time. Got a little squirrely there in the 2000 teens when the Fed basically left the target rate essentially at zero for an extended period of time. But it's a chart that comes to mind every time we talk about, whether the Fed will lower rates. Treasury market's telling you that that's pretty much a guarantee here. Dollar, not much of a change from yesterday's close, by the way. Looking at commodities, generally lower. And shouldn't you see natural gas spike a little bit? I mean, not much. It's up about 1/3%, but that natural gas prices have been in a primary downtrend for quite some time, just started to turn higher here in the last week or two. Crude oil prices remain fairly weak. The energy sector kind of middle of the road today. Precious metals coming off. This is after making new all-time highs earlier this week for both gold and silver. Down slightly, gold down about 0.4%, silver down 1.1% using their fairly liquid ETFs. Cryptocurrencies continue to show some weakness here. Bitcoin briefly over the last 12 hours dipped below 110,000. We're trending back higher here over the last 6 hours or so, up above 110,400. Ether prices holding above 4,300, but both of those, indeed the rest of the top 10 coins, all trending lower. I've started to trim a position in Bitcoin. I saw plenty of a bet going as a longer term play, but some of the short term, the short term weakness is telling me I probably want to rotate into some other things. And so I'm taking a bit of that off, but still a position and still a decent position in gold and plenty of stocks. Not the specific ETFs we just looked at, but similar enough ones. Looking at the 11 S&P sectors, we can see it was almost all positive. The utility sector was slightly lower and consumer staples were flat, but everything else had a pretty good day. Best days at the top of the list. We're going to talk about Amazon in a bit, but consumer discretionary, the XLY leading the way higher, up 1.1%. Industrials number 2. The XLI was up 1.1%. Financials are up 1.1% as well, followed by communication services. So kind of a growthy, but also value feel at the top, with industrials and financials having pretty decent days as well. By the way, latest episode of the Market Misbehavior podcast. I just recorded it earlier today. It's with my video producer. Hopefully we'll get it out to you tomorrow. But it is with Larry Tentarelli. Larry's the editor of Blue Chip Daily Trend Report. Fantastic, kind of a pure stock picker, in my opinion. Does a great job using technical analysis to identify strong trends. He always has some examples of charts that are working that he's placing bets on. And I hope you enjoy the conversation. We talked about process, talked about approach, talked about charts, risk management, some of his lessons learned. He started a little bit earlier in 1998. I started in 2000. but we compared some notes about some formative years with the tech bubble bursting. And he had some great stories from that era, but then we focused a lot on the current market environment about rotation. So check that out as soon as it's released on our YouTube channel, of course, but also on all your favorite podcasting platforms. Let's check in on breadth indicators. Breadth was kind of neutral earlier in the day. As the day progressed, got better and better. The advances on the New York Stock Exchange pretty strong. About 72% of the NYSE members were up, 26% were down. The Nasdaq Composite a little more measured, with only 53% up, but far outnumbering the 44% that were down. And the breadth in the mid cap and small cap space remarkably strong. 4-to-1 ratio of advancers versus decliners. So plenty of strength in the market today as the S&P sort of testing new all-time highs. Our market trend model bullish on all time frames as of Friday's close. Here's the Amazon thing I was telling you about. And I've seen some comments and questions about Amazon so far in the chat. Amazon, indeed, the best performer out of the Mag 7 names, up 4.3% today. We can see Netflix up 2.6%. That's impressive. And then Meta up 1.6%. I mean, the most compelling charts here, I think, to think about are these ones like Amazon that have been sort of, choppy sloppy, right? These are ones that have been sort of backing and filling. Apple did that for a while, started to break out. Some of these charts are not particularly in a position of strength right now, right? Meta gapping higher after making a new swing low 2 sessions ago. So, for every we'll say like a Netflix, or excuse me, a Nvidia testing new all-time highs, Alphabet breaking out to new all-time highs, Meta testing new swing lows. It's a very diverse group of stocks all of a sudden after being almost entirely bullish, May, June, July kind of time frame. What a difference a month makes, right? August has seen a lot of these pulling back. And I think the real story for this market, when you think about market activity between now and year end, if you're expecting significant further upside in the S&P and the Nasdaq, and you're looking for a big Q4 rally to give a strong finish to the year, we need to see names like Meta do a lot better than they are. And the reason why I set all that up is I think the gap higher in Amazon is pretty encouraging, because if that continues and we see a break to new highs, I think that'd be pretty bullish. We're going to look at the market carpet here in a moment. Let me take a look at Amazon here very quickly. And I will remind you, I can see questions as they're coming in, live streaming on Facebook, LinkedIn, YouTube, and X. Can't tell you how much I appreciate you guys tuning in live. If that's something you're up for doing, happy to have you join me. Happy to have you ask questions along the way. Helps me to think about how to just tailor the conversation through the time together. If you're watching the replay on our YouTube channel, I appreciate you as well. Put any questions that come up in the comment section. We gather all those questions, and we'll do a mailbag episode tomorrow on Friday of this week. We love to answer one of your questions on the show. So make sure you put your questions, get them in now. So what's good about the chart of Amazon? I'll tell you what it is. It's the fact that we're arguably sort of exiting out of a coil pattern. We talked about this pattern on Tesla, which is a consolidation pattern where you basically have a narrowing of the range, right? We talked about an uptrend is higher highs and higher lows. A downtrend is lower lows and lower highs. What about when you have lower highs and higher lows? That is a narrowing of the range, what's called a symmetrical triangle or coil pattern. We saw that with Tesla, which actually had some failed breakouts trying to break out of that pattern to the upside. John Murphy, in his writings, which first book I ever read on technical analysis, I'll never forget, it talks about how a triangle pattern like this, usually about 2/3 to 3/4 of the way through that pattern, is when you often get the breakout to the upside or the downside. The triangle in itself doesn't really tell you which direction we're going to go. You have to wait for the breakout. And today, arguably, we're getting a validation of an upside breakout out of that coil pattern. I would need to see follow through tomorrow. I'd want to see additional follow through, really pushing above that July high, ideally. But the fact that we're closing out of that pattern is pretty bullish. And, barring some big sell off tomorrow that puts us back into that pattern, that suggests strength going forward for this leading growth name. So symmetrical triangle or coil pattern, pretty bullish when it resolves to the upside, like we just saw with Amazon. Here's Amazon there at the top center of the heat map. As we're looking at the market carpet, you can see the rest of consumer discretionary generally doing pretty well. You'll see home builders continuing to move to the upside. Anyone that I've talked to recently has brought up home builders as a strong chart. This came up in my conversation earlier today with Larry Tentarelli. It's come up with other conversations as well, as I've tried to mentally get back from vacation mode to work mode. I'm trying. I'm getting there. I'm getting there slowly but surely. But as I'm reviewing the evidence, I mean, what a remarkable story with home builders. And I did the top 10 stocks or top 10 charts with Grayson Rose yesterday. I didn't see if that was released yet, but home builders were one of the 10 charts that we talked about. And that's not just a technical story of the charts going higher, which they are. If you look at the XHB or the ITB, those are the two most popular home builder ETFs. But it's also a macro story, right? If the Fed is lowering rates, if 10-year yields continue to go down, that means mortgages are going to be a little less expensive. That means housing more accessible. And it's good news for home builders. So kind of a nice tailwind given the interest rate environment, how it looks to be sort of resolving to the downside most likely. You see some strength in industrials. You'll see some strength in financials. Those were two other strong sectors today, particularly in industrials. Some of these aerospace names, looking at GE Vernova there. What else was I looking at? Raytheon really didn't have that great of a day, but it's coming off of a new all-time high at the end of August. Also within the financial sector, we'll see things like Goldman Sachs making a new high, American Express, which was actually one of my 5 charts that I contributed to the top 10 charts dialogue that should be out on Stock Charts TV here very soon. AXP threatening new all-time high. So the financial sector continuing to show quite a bit of strength. Technology, though, not as great as you'd think, right? If this is such a bullish day and things are making new highs. Now, there were some names doing well, particularly some of the semiconductors that are actually having some nice counter trend bounces higher. Micron, LRCX, KLAC, all bouncing higher. That's great. But you have Texas Instruments down over 4%. Salesforce got absolutely clobbered with earnings. And arguably, this has been probably one of the worst charts in technology in the S&P 500 members, but not looking any better today. But I think the real story in technology is that the fact that the 3 biggest names, NVIDIA, Microsoft, Apple, were up, but just not up a ton, right? They didn't outperform. They weren't big moves to the upside. They were kind of slight gainers. Broadcom's one to watch. Obviously, that's an earnings name today after the close. Looked like things went fairly well. From a technical perspective, it's kind of a bit of a coil pattern here as well, right? You can see lower highs and higher lows. You'd want to see an upside resolution to this pattern with the 21-day EMA sloping higher. The challenge for the chart of Broadcom has been declining momentum. We had a bit of a divergence there at the all-time high in mid-August. So stronger upswing on stronger momentum would be a great way of resolving that move to the upside. All right, let's finish off looking at some charts together. The S&P 500 chart, I mean, no change in my general assessment here, right? I mean, for me, the weekly process, what I call the weekly flight plan, I put that out to all my market misbehavior premium members over the weekend. We talked about some key levels on the S&P. And the way that I think of this is, number one, define the trend, right? Is the trend bullish or bearish? The trend is clearly bullish on the S&P up until today, up until and including today, I would say. So once we determine that the trend is up, we don't have to use any great technical prowess to determine that the trend is higher. It's kind of obvious looking at the chart. So while we're looking for are signs that the trend is no longer bullish, what I call changes of character, right? Some sign that this uptrend is no longer working. Now, I would say there are some leading indicators that try to help us anticipate that most of those that I use are not particularly bullish right now, right? Momentum has been declining since late July, which tells me these new highs are driven by less momentum. That's not great. But any of the lagging indicators, like are we breaking any key moving averages? Are we breaking any recent support levels? That's a no across the board. So some leading indicators, suggesting we're in like inning 8 or 9 as opposed to inning 2 or 3 of this uptrend, but no real trend following tools, at least on the S&P, telling me to be concerned. 6350 remains that level that I'm watching. That's also the 50-day moving average. Another leading indicator that has me kind of scrunching, one of my former analysts at Fidelity, Mark Dibble, I'm just honestly a fantastic technical analyst, a genuinely awesome guy who I miss working with. Mark would always share with the team thoughts while shaving, right? Things like you're in the, shaving in the mirror, you're just like thinking about the markets apparently. And, what sort of, thing, just kind of, thoughts that come to mind. And for me, one of those nagging thoughts while shaving is this Dow theory non-confirmation an issue? This is an adaptation of Charles Dow's work where he looked at the Dow Industrials and the Dow Railroads. And I think a more modernized version is an equal weighted S&P 500 versus the equal weighted NASDAQ 100, kind of the old economy and the new economy. By looking at equal weighted indexes, we're not just looking at the mega caps, we're kind of looking at the broad groups of stocks that those indexes represent. The reality is the equal weighted S&P made a new all-time high in August. The equal weighted NASDAQ 100 did not. So kind of the market as defined by the S&P is still doing fine, but those leading growth names that are the NASDAQ 100 are not as fine. And this non-confirmation can often be a really negative sign. We've had some non-confirmations that have worked remarkably well. I mean, famously in February of 2025, the equal-weighted NASDAQ made a new high while the equal-weighted S&P did not. That's a pretty bearish sign. We also had a non-confirmation in June of this year, but the way that you kind of negate that and move past it is both of these eventually resume their uptrend and make new highs. So if that would happen and the equal-weighted NASDAQ 100 pushes above 100, I think that's back to a confirmed bullish trend, thumbs up. But right now it's it's not great and it's not confirming just yet. And that's part of that rotation that we talked about. Now, are we seeing a great leadership rotation from growthy offense into defensive sectors? Big time, no. Here is the offense to defense chart. We have the market cap weighted version in the top half, the equal weighted version in the bottom half. This is looking at the ratio of consumer discretionary versus consumer staples. I absolutely love this ratio, and I've followed it for many, many moons. And the reason is because when conditions are good and when consumers are optimistic and they have money to spend, they spend money on things they don't need, but they want. Things like a new watch, travel, tourism, new clothes, fun stuff, discretionary things you don't need, but you want. When things are going bad, you still probably have consistent spending on things like toilet paper and beverages and tobacco and food. And maybe you're changing some behavior, but you still have those normal kind of expenses, things you just need to survive and not that are wants, right? And so by looking at this ratio, we can see if if the market is telling us conditions are good, investors are spending money on things they don't necessarily need, but they want. That means they've got money to throw around and they're doing it. And that is what we're seeing here going into early September of 2025. The cap weighted and equal weighted versions are both breaking out. The equal weighted version today with that Amazon move higher, making a new all-time high. So offense still dominating over defense. This ratio in particular, which has served me quite well at helping me recognize when conditions start to rotate. I'm not getting any negative signs just yet. Let's talk briefly here about some sentiment readings. We can see the AAII survey updated every week. That's reported, usually end of day Wednesday into Thursday morning. And so today's reading has 33% bulls, 43% bears. That's a couple ticks left in terms of bulls, a couple more ticks in terms of bears, which means the spread's about 11% of bears outnumbering bulls. That has been the case since the end of July. Most of 2025, we've been in this situation where bears have been outnumbering bulls. That was not the case in late June and mid-July. So I think one of the more bullish things we could see would be this survey actually turning more net positive. This tells me there's still quite a bit of skepticism in the month of August, which is kind of how this market has felt for sure. I think a part of that is obviously a lot of that survey is a lot of individual investors. I would guess many individual investors have let big growthy names like Palantir and NVIDIA and others become huge parts of their portfolio, which means then when those things pull back, which they have, I mean, your portfolio shrinks just as quickly as it had grown in the bullish part of that cycle. Maybe we're feeling the pain of that overweight. The name exposure index down a bit today, this week. Last week it was around 93%. Today around 82%. So about a 10% drop in the average allocation according to this survey. This is a weekly survey of money managers where they're asked their equity allocation from 200% long to 100% short. And you can see it's currently around 82%. Honestly, that's about as middle of the road value as I can expect. What this tells me, though, is that money managers in this survey are not like way leveraged, long, over leveraged. We saw that most recently almost at 100% at the end of June. We saw that at the end of 2024. Not really seeing an issue with that right about now. All right, let's talk about some individual stocks. Nvidia continuing to kind of toe the line here. I think the chart of Nvidia above the 50-day moving average, ideally above 185, making new highs, is a remarkably strong chart. And that would obviously be a very bullish resolution to this sideways pattern that we've been in. This rectangular, what we call a consolidation zone that we've been in, the lower end is around 170. The 50-day moving average just above there around 172. We closed below the 50-day on Tuesday, first day after the long weekend. And then the next 2 days, we've basically just been remaining. We've been treading water in that same range. So we haven't really had this big follow-through day that tells you, we're puking out NVIDIA, this thing's breaking down. We kind of had this initial break, and then we're stalled out here. So I think it's still an open question. I think it's an important chart to watch. Of course, the signs were definitely there going into mid-August that those new highs and attempts to new highs were made on much weaker momentum. We really haven't had that breakout yet. I would still describe that chart as neutral until proven otherwise. Bitcoin in this particular chart, IBIT, is one I was looking at earlier this week with Grayson Rose at Stock Charts TV. And in the studio, we were talking about Bitcoin. I mean, I still have a decent bet in Bitcoin. I own IBIT in terms of full disclosure. The short-term pullback is definitely the case here. When you think about the larger structure, though, I'm looking at this pattern, right? Here are the highs from December of 24 and January of 25. It's right around $60 for IBIT. Pulled down quite a bit to around 43, and then we had this big acceleration up to a high around 69. We basically double topped and made a secondary high around 70, and that was a couple weeks ago, early August. From there, we've rotated lower. We broke below the 50-day moving average, which is not great, but I'm looking at the 38.2% retracement of that April to July rally. That puts us in just below 60, and that lines up really well with those swing highs in December, which were significant highs. I'm thinking of this as a pivot point, and I think if we break below that level, and if we break below the 200-day, I think that all of a sudden this becomes a significantly negative chart, and I would be probably aggressively unwinding a position in Bitcoin, or at least taking a lot more of the bet off the table. For now, it feels a lot more like a pullback within a big uptrend, which has happened many times in the history of Bitcoin. By the way, the last big sell-off that we had was in Q1 going into the April low. That found support right at the 200-day moving average. Home builders continuing to impress. It's above an upward sloping 21-day EMA, which was above an upward sloping 50-day moving average. The 200-day moving average just flattening out. I love the move in home builders. It's an area that we've been focused on. It's a great play on rates, but it's also a significant improvement in the technical picture. Higher highs and higher lows are bullish. Home builders are trending higher. Clorox, I got a question on this actually, and instead of putting it in the mailbag, I just want to throw it here. Talking about how to play a chart like Clorox. And, again, what I would tell you is with charts like CLX, it certainly appears to be a double bottom pattern. The double bottom pattern, just a basic way of describing, we hit a level, we bounced off of it, we tested it again, and then we rallied. So when you have that kind of double bottom pattern, there's two ways I would generally think of to play it. Number one, the more aggressive version is you buy the second low. As soon as you're comfortable taking on that risk, you buy because you're more value oriented. You love buying it at a position of weakness, betting on the fact that we're going to rotate higher. And so far, that's been proven right, at least in the first couple days here in September. And then I would basically, personally, I would be using those lows, right? What I'm basically saying is this is a double bottom pattern. I'm buying that pattern, which means if it's not a double bottom pattern, then that thesis is scrapped because it was wrong. And so if we would break below 117 and clear that support level to the downside, I'd probably unwind the position. So I buy the double bottom using that low as a stop, and then I'm betting on a move at least up to the swing highs around 130. If you're a little more of a conservative investor and you're looking for a validation that this chart is now in a period of accumulation, that's where I would be looking instead for a break above the July swing high around 130, 130, 50. And I think for there, that's the alert. It breaks above that, then that's a confirmed double bottom pattern. It's showing signs of accumulation. We get farther with the momentum. I think that's a pretty good chart, getting stronger, but impressive bounce off of the lows. Couple questions that came in as we were doing the show here. Do you use the equal weighted S&P when analyzing charts? Richard, thanks for being a longtime viewer and frequent question asker. I mentioned that earlier using the newer Dow theory. I hope you saw that, looking at the RSP and then the QQQE, which is the equal weighted NASDAQ 100. I like looking at the two of them together because it's a, the cap weighted S&P is basically the Magnificent Seven stocks and then a bunch of other stuff. The equal weighted S&P is really looking at the market of stocks and really looking at that entire group and how they move. So 100%, I think that's a great way of thinking of breadth is look there. Other question, Port Royal. Thanks for asking and thanks for watching on YouTube. You asked when September starts Septembering. It's a really good question. I'll show you a couple charts because I was actually going through these with my Market Misbehavior Premium members. Friendly reminder, never too late to become a Market Misbehavior Premium member. You can learn more at marketmisbehavior.com/premium. Use the code YouTube for 30% off your first 12 months on any plan. If you like what I'm doing here on the show, if you want more help, more support, access to virtual courses, a member community, and the ability to ask questions of me anytime you want, day or night. I'm not going to be up all day or night, but I will be looking at it every day. You can become a premium member. Again, use the code YouTube when you go to marketmisbehavior.com/premium. Hopefully would a good way to upgrade your decision-making between now and year end. But I'll show you three quick charts. September is seasonally the weakest month of the year, depending on how you analyze it. This is looking at the last 5 years, right off of the COVID low. So if we start the clock at the beginning of 2020 and go through the end of last year, what's tended to happen in each of the 12 months? Well, we can see that summer months have been remarkably strong and really late spring, May, June, July, which obviously were quite strong here in 2025. That's been the story for a number of years. July has been the strongest, right? If you look at July was up 100% of the last 5 years, average return 4.4%. Here's the problem. When you get to September, it's been only up one of the last 5 years. So one of the 5 years post-COVID, average return is negative 4.1%. Now there's some big down Septembers that are probably skewing that average, but overall it's not been a great month and by far the worst of the bunch. But depending on when you start the clock, you'll find some different data. So this is actually looking at the last 20 years. And you can see that, again, while July has actually been a pretty strong month for quite some time, we can see that there's, August a little weaker, September still the weakest month, but October is actually up even less, right? It's up almost half the time as opposed to more than half the time. So the reality is the seasonality would tell you September is most likely going to be a rough month. Now, I've interviewed some fantastic experts on seasonal tendencies. Most often, who have I? Jeff Hirsch, right? Yale Hirsch's son. Jeff Hirsch is the editor of the Stock Traders Almanac. His father, Yale Hirsch, is credited with popularizing seasonality as a thing we even know about. And interviewing Jeff, he would tell you, look, my father would tell me that these are not absolutes. Just because it's May, just because it's October, that should not mean you do anything. But what it should tell you is this is sort of the tendency. All else being equal, if nothing else kind of significant is there to move the markets, here's what's most likely going to happen. But Jeff will admit first off that seasonality should not be your game plan. You also, as always, want to focus on what's actually happening. So he actually applies a trend following overlay to his use of seasonal tendencies, looking at the 12-month cycle. And so while September is often a weak month, if September keeps going up, I'm still going to want to own things that are going up there. So for what it's worth, September seasonally a weak month of the year. It's not so weak just yet, and I am focused very closely on key levels and patterns that would tell me a downturn is happening. I'm not seeing it yet, though. Keep watching the show, keep following my work, and I promise I will let you know as soon as I see those shifts happening. For now, I will say thank you so much for joining me here on the show. Great to be back. A pleasure to be speaking with some of you live. Keep your questions coming. We'll do an all mailbag episode on Friday. Then we'll be back to normal, hopefully, on Monday of next week. Have a great night. Remember, it's always a good time to own good charts. Take care, folks.